Okay, let's unpack this. I want you to imagine a scenario that I think every single person listening has faced at least once.
Oh, I think I know where you're going with this.
You're an investor. You've been diligent. You put your money into a mutual fund or maybe a portfolio management scheme about a year ago. You get that email notification. Your annual fact sheet is ready.
Right. The moment of truth.
You open the PDF, you scroll past all the legal disclaimers, and you finally hit the performance table. And suddenly you are just in a complete fog.
Wall of numbers. It's a classic experience. A bit overwhelming.
It really is. You see a CAGR of, say, 12%. Then right next to it, an XIR of 14%. Then there's an absolute return of 11%. And then, just make you feel completely inadequate, there's a Sharpe ratio and a Treynor ratio just staring back at you. You look at your account balance and you know it's higher than when you started, so you made money. But the burning question, the one that actually matters, is usually left unanswered. Do I actually do well?
That is the ultimate investor paradox, isn't it? Right. Making money and generating a superior risk-adjusted performance are two completely different things.
How so?
Well, you can make money and still be a terrible investor if you took reckless risks to get there, or, if you underperformed a simple index fund that took way less effort.
And that confusion is exactly why we are here today. We are on a very specific mission. We are taking a rigorous, line-by-line deep dive into Chapter 16 of the NISM Series XA certification material.
The big one.
Portfolio Performance Measurement and Evaluation.
This is arguably the most heavyweight chapter in the entire curriculum.
Yeah.
If you are preparing for the exam, this is, as they say, where the rubber meets the road.
So this isn't just about profit.
No, not at all. We aren't just talking about profit in a vague sense. We're talking about the mathematics of skill versus luck. We're going to separate the signal from the noise.
And I'm going to play the role of the student today. I've got my calculator out, I've got the formulas in front of me, and I'll be honest, some of this math looks a little intimidating.
It can be.
So my goal is to pass this exam, which means I'm going to ask the questions that might seem basic, but I absolutely need to understand them to clear the test. I want to push past the textbook definitions and really get to the logic.
That's the right approach. There are no basic questions in Chapter 16, only foundational ones. My role is to be the mentor. I'm going to help you interpret these measures, but more importantly, I'm going to highlight exactly what creates a red flag or a specific question on the exam.
Okay, so what's the roadmap?
We have a lot of ground to cover. We'll start with return measures, then risk measures, then we'll combine them into the ratios, and finally we'll talk about benchmarking and attribution. We are not skipping anything.
Perfect. Let's dive right in. The chapter starts with the most fundamental question. How much did I make? This brings us to section 16.2.1, the holding period return, or HPR. What exactly is this?
HPR is the starting point. It is the most straightforward rate of return you can calculate. In the industry, it is popularly known as total return, or maybe point-to-point return. The definition is incredibly simple. It is the total income generated by an investment plus the change in the value of that investment divided by the beginning value.
Okay, so it captures both the cash in my pocket like dividends or interest and the paper appreciation of the asset itself.
Precisely. The formula you need to visualize is HPR equals a big fraction. On top, you have income plus, in brackets, the ending value minus the beginning value.
So income plus the capital gain.
Right. And all of that is divided by the beginning value. It's basically income plus gain divided by your initial cost.
Let's put some real numbers on this to make it stick. The text gives a specific example using the Indian market. Can you walk us through that?
Sure. Let's visualize a stock portfolio. Imagine you bought a portfolio on April 1st, 2018 for 1 lakh rupees.
Okay, so that's my beginning value.
That is your B. Now, fast forward exactly 1 year to March 31st, 2019. The market value of that same portfolio is now 1,20,000 rupees.
That's the ending value, E. So I've made 20,000 on the price appreciation alone.
Right, but that's not all. During that 1 year, you also received 5,000 rupees in dividends and interest income.
Yeah.
That is your I.
Got it.
So to calculate the HPR, we take the 5,000 income, we add the 20,000 capital gain, which is the 1.2 lakh, minus the 1 lakh, giving us a total numerator of 25,000.
And we divide that by the starting 1 lakh.
Exactly.
Which gives us 0.25 or 25%.
Correct. A 25% holding period return. It tells you that for every rupee you put in, you got 25 pays back in total value.
That seems easy enough. Almost too easy. I noticed a limitation mentioned in the text. It says, this measure assumes all income comes at the end. What does that mean?
Yes, and that is a critical flaw. HPR assumes that the dividend you got maybe halfway through the year in September just sat there doing nothing.
Oh, I see.
It doesn't account for the reinvestment of that income during the holding period. It's a simplification.
Right, because if I got that 5,000 rupees in September, I probably would have bought more stock with it, and that stock would have grown by March.
Exactly. HPR misses that compounding effect within the period. It is a simplistic point A to point B measure. It's widely accepted as a quick check, but for a professional portfolio manager looking at complex cash flows, it's rarely, if ever, enough.
That leads us directly into section 16.2.2, which feels like one of the most important concepts in this entire deep dive, the battle between TWRR and MWRR.
Ah, yes. If you take one thing away from this entire session, let it be this distinction. You simply cannot pass the exam without understanding the difference between the time-weighted rate of return, TWRR, and the money-weighted rate of return, MWRR.
Okay, break it down. What is the fundamental difference? Why do we need two different ways to calculate a percentage return on the exact same portfolio?
Because there are two different stakeholders involved, and we're asking two different questions. MWRR measures the client's performance.
Okay, the client's experience.
Yes. And TWRR measures the fund manager's performance.
Interesting. Why would the client's return be different from the manager's return? They're looking at the same pot of money.
Because clients control cash flows. That's the key.
What do you mean?
Clients decide when to deposit money and when to withdraw money. The fund manager usually has no control over that timing. MWRR accounts for the timing and size of those cash flows. In financial textbooks, MWRR is effectively the same thing as the internal rate of return, or IRR.
IRR is a term I hear a lot. Can we visualize how the math works for MWRR? I know we don't need a spreadsheet in front of us, but how does it think?
Imagine a spreadsheet. That's the best way. In one column, you have dates. In the next column, you have cash flows.
Okay.
When you invest money, it's a negative number cash leaving your pocket. When you withdraw, or at the final valuation, it's a positive number cash coming back to you. MWRR is the discount radar that makes the net present value of all those inflows and outflows equal to zero.
So let's say I'm a client. If I put a huge chunk of money in right before the market crashes, and then I panic and sell right at the bottom.
Your timing was bad.
My timing was terrible, so my MWRR will look awful.
Exactly. And that is why MWRR is the standard for reporting to individual clients. It reflects their personal reality. On the flip side, if they ran SIP during a market dip, buying more units when prices were low, their MWRR might actually be higher than the fund's official return. It captures the impact of their behavior.
Okay, so if MWRR is for the client because it includes their timing decisions, TWRR must be for the manager. Why?
Because it wouldn't be fair to penalize a manager just because a client withdrew 50% of their portfolio 2 days before a massive bull run. The manager can't control that.
Right, they can only manage what's in the account.
If the client pulls money out, the manager has less capital to grow, but that shouldn't drag down their percentage performance metric. TWRR, or time-weighted rate of return, eliminates the distortion of cash flows. It calculates the compound rate of growth of 1 unit of money, say 1 rupee over the period, assuming no money was added or withdrawn.
How do we calculate TWRR then? It sounds more complex than just solving for R if we have to strip out the cash flows.
It is. It's a chain linking process. Here's the methodology you need to know for the exam. It happens in 4 steps.
Okay.
Step 1. You break the total evaluation period into subperiods. A new subperiod begins every single time there is a significant cash flow. So if a client deposits money on April 15th, the first period runs from the start to April 15th.
Got it. Cash flow creates a new period.
Step 2. You calculate the HPR, the holding period return we just discussed, for each of those subperiods individually.
Okay.
Step 3. You convert those returns into something called wealth relatives.
Wealth relatives. That's a new term. Sounds a bit fancy.
It does, but it's just 1 plus return. That's all it is. If the return is 5%, the wealth relative is 1.05. If the return is negative 5%, the wealth relative is 0.95.
Simple enough.
And finally, step 4. You geometrically link them. You multiply all those wealth relatives together. So 1 plus R1 times 1 plus R2 times, all the way to 1 plus Rn. Then you subtract 1 at the very end to get the final percentage.
I see. So by breaking it into chunks, you are isolating the performance between cash flows. You are effectively treating every cash flow as a reset button, neutralizing the impact of the money coming in or out.
Precisely.
Yeah.
You are measuring the manager's ability to grow the money that was available to them at that specific time. And here is a massive exam flag. You need to circle this in your mental notes.
I'm ready. What is it?
You need to know the regulatory stance on this. The SEBI, Portfolio Managers, Regulation 2020 mandates that discretionary portfolio managers must disclose performance using TWRR for periods exceeding 3 years.
TWRR is the mandate.
Got it.
Why is SEBI so specific about this? Why not MWRR?
To ensure uniformity and fairness in advertising and reporting. Imagine if a manager got lucky. A client deposited 10 crores right before the market rallied. If they used MWRR, their return would look artificially high because of that timing luck.
Which they had nothing to do with.
Exactly. TWRR strips that luck away. It isolates skill. Now, mutual funds use net asset value, NAV, which is essentially a TWRR calculation because it's calculated per unit. But for PMS strategies, where every client portfolio is different, SEBI insists on TWRR to compare apples to apples.
That is a crystal clear distinction. Client experience and timing equals MWRR. Pure manager skill equals TWRR.
You've absolutely got it.
Okay, moving on to section 16.2.3, the text discusses arithmetic mean versus geometric mean. I feel like this is a classic trap for new investors who just look at average return.
It is the average return trap. It's so easy to fall into. Let me give you a scenario to prove why arithmetic mean can be so dangerous.
Okay, let's hear it.
Year 1, your portfolio loses 50%.
Ouch.
Year 2, your portfolio gains 100%. What is your average return?
Well, mathematically,
Yep.
it's minus 50 plus 100, which is positive 50. You divide that by 2 years, so that's at 25% average return per year.
Sounds great, right? 25% average return. You'd be thrilled with that. But let's look at your wallet. You started with 100 rupees. In year 1, you lost 50%, so you now have 50 rupees left.
Right.
In year 2, you gained 100%. So you double your 50 rupees. What do you have?
100.
So you started with 100 and you ended with 100. How much profit did you make?
0. I made 0.
Exactly. But the arithmetic mean says you made 25% year.
That is wildly misleading. The math says 25%, but the reality, my actual bank balance says 0%.
And that is why we use the geometric mean return, which you'll also hear called the compound return, or CAGR. The geometric mean takes the path into account. It multiplies the wealth relatives rather than just adding the percentages. In our example, the geometric mean would correctly calculate to 0%.
So when do we ever use the arithmetic mean? Is it just completely useless?
No, not useless, but it has a very specific purpose. The arithmetic mean is the best estimate of the expected return for a single year in the future based on historical distribution.
A forecast, basically.
Sort of. If you want to guess what might happen next year, looking at the average of past years is statistically valid. But if you want to measure actual past performance over a long period like 5 or 10 years, you must use the geometric mean. The path matters.
Okay, let's get into the weeds of fees. Section 16.2.4 covers gross versus net return. We all know fees exist, but the text provides a very specific waterfall calculation using a 100 lakh portfolio. I think we should walk through this because the order of deduction must be important.
The order absolutely matters. Gross return is the vanity metric. It's what the assets did.
Yeah.
Net return is the sanity metric. It's what you actually get to keep.
Vanity versus sanity, I like that.
Let's trace the path of 100 lakhs invested for 1 year with a 20% gross return.
Okay, so 100 lakhs becomes 120 lakhs gross value. We made 20 lakhs in profit on paper. Now come the fees.
Right. First, we look at the upfront fee or setup fee. In the text example, this is nil, which is pretty standard these days, but historically it would come out of the capital contribution immediately. So nothing there. Next, we deduct other expenses. This captures brokerage, DP charges, custody fees, things like that. The text assumes 0.50% charged on the gross value.
On the 120 lakhs.
Correct. So 0.5% of 120 lakhs is 60,000 rupees. We deduct that.
We are down to 119.4 lakhs.
Now, the fixed management fee. This is usually charged on the average capital over the period. The text uses 1.5%. The average value of the portfolio, which is the start of year value plus the end of year value, divided by 2 is calculated, and 1.5% is deducted. In the example, that's about 1.65 lakhs.
Okay, so we are chipping away. Now, what about the performance fee? This is very common in PMS, right? The 2 and 20 model.
Very common. But here is the catch, and it's a critical one, the hurdle rate. The manager only gets a performance fee if they beat a certain return.
A minimum threshold.
Yes. In this example, the hurdle rate is 10%. So on a 100 lakh portfolio, the manager has to generate at least 10 lakhs of profit before they can even think about earning a bonus.
So how is it calculated here?
Here, the gross profit was 20 lakhs. The hurdle was 10 lakhs. The excess profit is the difference, so 10 lakhs. The manager takes a percentage of that excess, let's say it's 20%.
So 20% of the 10 lakhs above the hurdle, so another 2 lakhs gone, roughly.
Correct, specifically 1.55 lakhs in the tax calculation after adjusting for the other expenses first. The order matters.
And there's one more, the exit load.
Yes, if you leave early. The example assumes a 2% exit load on the final withdrawal value if you pull out within a certain time frame.
So after all is said and done, after this waterfall of fees, what happened to my glorious 20% return?
After deducting all those expenses, the fixed fees, the performance fees, and the exit loads, the net value in your account is roughly 113.8 lakhs.
Which means my 20% gross return became a 13.88% net return.
There you go.
Wow, that is a massive difference. Over 6% of the return just vanished into fees and charges.
That is the big exam flag here. Investors often get sold on gross returns. It's the big, shiny number. But for your own evaluation, net return is the only metric that matters for wealth creation. If you ignore the fee waterfall, you're living in a fantasy land.
Moving on to section 16.2.5, we're not done with deductions, taxes. The government wants its share too.
Always. The formula is simple enough. Your post-tax return, pre-tax return, one tax rate.
Right.
And the text gives a great comparison between a fixed deposit and equity. An FD might offer 7% pre-tax, but if you're in the 30% tax bracket, your post-tax return is significantly lower, maybe around 4.9%.
Whereas equity has different tax rules.
Exactly.
Right.
Equity has historically enjoyed lower tax rates, like 10% or 15% for long-term capital gains, LTCG, which really widens the gap in post-tax performance. The source uses a 15% tax example just to illustrate this difference.
And closely related to all of this is CAGR, or compounded annual growth rate.
KGR is the smoothing tool. It's the geometric mean we just talked about. It ignores all the volatility in between and just asks, if this investment grew at a steady, constant rate every single year, what would that rate have to be to get from the start point to the end point?
And the formula for that is the one we should visualize.
Yes. It's ending value, beginning value, that whole thing raised to the power of one number of years, and then you subtract 1 from the result.
So if I tripled my money in 5 years, it's 3 divided by 1, raised to the power of 1 divided by 5, then minus 1.
You've got it. And this same logic applies if you need to annualize a return. Let's say you made 5.6% in just 4 months, and you want to know what that looks like on a yearly basis.
How do you project that out?
You use a similar logic. You take 1 row plus period return and raise it to the power of year period.
So 1 plus 0.056 raised to the power of 12 months, 4 months, which is 3.
Right. It compounds that 4-month performance out for a full year. The useful tool, but you have to be careful. It can be misleading if that 4-month period was just a lucky streak.
Makes sense. Now let's shift gears to section 16.2.8, cash drag. This sounds like a physics problem.
It feels like one, doesn't it? Cash drag happens when a portfolio manager holds a portion of the fund in cash or very liquid assets, like a liquid fund.
Why would they do that?
A few reasons. Maybe they're waiting for a good buying opportunity, they've just received new funds, or they're just fearful of the market and want to be defensive.
And how does that drag performance?
In a rising market, cash earns very little, say 4%, while the stocks in the portfolio might be earning 10% or 15%. That cash portion, earning next to nothing, drags the overall weighted average performance down.
Can we calculate the cost of this drag?
Yes, quite easily. It's a weighted average. Imagine a manager has a 100 lakh portfolio, 75 lakhs are in equities returning 10%, and 25 lakhs are sitting in liquid funds returning 4%.
Okay.
The weighted return is 0.75 10% plus 0.25 4%, which comes out to 8.5%.
But if they had been fully invested in equities?
They would have made 10%. So the cash drag costs the portfolio 1.5% in returns. That's the price of being cautious or uninvested.
That's significant. It explains why some funds underperform the index in a strong bull market. They simply weren't fully deployed.
Exactly.
Now we get to the heavy hitters, alpha and beta. Section 16.2.9. These are terms everyone throws around, but I want to make sure we define them strictly for the exam.
We have to. And to do that, we have to start with the CAPM logic, the capital asset pricing model.
Okay.
The theory says you deserve a return for the risk you take. There is a risk-free rate, let's call it RF, which is what you get for just showing up, like buying a treasury bill.
The safest investment possible.
Right. Then there is the market risk premium, which is the market return minus the risk-free rate. It's the extra reward you get for taking on market risk. Your portfolio's exposure to that market risk is measured by beta.
So the formula is?
The required return, risk-free rate, plus beta, market return, risk-free rate.
Okay, so that formula calculates what I should have earned given the risk I took as measured by beta. What is alpha then?
Jensen's alpha is the difference between what your portfolio actually earned and that theoretical required return we just calculated.
So it's the outperformance.
It's the outperformance above and beyond what was expected for the level of market risk taken. If the model says you should have earned 20% because you took high risks, but you actually earned 25%, you have an alpha of plus 5%.
So alpha is the measure of the manager's skill.
That's the idea. Their ability to pick stocks that outperform the model. Beta is just the reward you get for riding the market wave. Alpha is the value they add on top of that.
Got it. Alpha is skill. Beta is market exposure. We've talked a lot about return. Now we need to talk about the other side of the coin, risk. Section 16.3 defines risk not just as losing money, but as uncertainty.
Correct. In finance, risk is variability. If an asset returns plus 40% one year and negative 40% the next, it is highly risky, even if the average return is zero. It's about the bumpiness of the ride.
And how do we measure that bumpiness?
We measure total risk using variance and its more famous cousin, standard deviation, which is just the square root of variance.
Can you help us visualize that?
Visualize a bell curve of possible returns. A high standard deviation means a wide, flat bell curve. The outcomes can be all over the place. A low standard deviation means a tall, skinny curve. The outcomes are very predictable and clustered around the average.
But the text also mentions downside risk. As an investor, I love it when the variance is to the upside. I only care if it varies downwards.
That is a very valid and very human psychological point. That leads to measures like semivariance or semi-standard deviation.
And what do they do?
They only look at the dispersion of returns below the mean or below a certain target return. They completely ignore the good volatility. They only penalize for downside surprises.
So why isn't that the standard? It seems more intuitive.
It is, but standard deviation is statistically easier to work with and has become the industry convention. So for the exam, remember that standard deviation is the most common measure of total risk, especially when we get to the ratios.
Okay, let's break down the specific risk metrics in section 16.3, starting with tracking error. What is that?
Tracking error is the standard deviation of the difference between the portfolio's return and the benchmark's return.
The difference. So it's not the portfolio's volatility, but the volatility of its outperformance or underperformance.
Exactly. Think of it as a measure of deviance, or how actively managed the fund is. If a fund has a very low tracking error, it means it is hugging the index. It's basically an index fund in disguise. If it has a high tracking error, the manager is taking big active bets away from the benchmark.
And this connects to the two fundamental types of risk, systematic and unsystematic.
This is a cornerstone concept in finance. You have to know this.
Let's define them.
Systematic risk is market risk. It's the risk that affects everyone. Interest rates rising, a recession, a war, a pandemic. You cannot diversify this away. If the market crashes, almost everything falls. This risk is measured by beta.
And unsystematic.
Unsystematic risk is unique risk. It's specific to a company or an industry. A strike at a specific factory, a CEO scandal, a bad product launch. This can be diversified away. By holding 20 or 30 different stocks, one company's bad news gets drowned out by the others.
So if I hold a well-diversified portfolio, I have essentially eliminated my unsystematic risk. The only risk I'm left with is systematic risk.
Exactly. And that distinction is absolutely vital when we choose which risk-adjusted ratio to use later on.
The text also briefly mentions liquidity risk and credit risk.
Yes, two other important dimensions of risk. Liquidity risk is often called impact cost. It's the difficulty of converting an asset to cash quickly without losing value.
Can you give an example?
A treasury bill has almost zero liquidity risk. You can sell it instantly at the market price. A piece of real estate or a rare painting has high liquidity risk. You might have to drop the price by 20% to sell it today.
And credit risk.
That's simpler. It is the probability of default, the risk that the borrower won't pay back the principal or interest on a loan or a bond.
Okay, we have the returns, we have the risks. Now we combine them. Section 16.4, risk-adjusted return ratios. Expert. This feels like the most exam-heavy section of the chapter.
It absolutely is. You will almost certainly see questions asking you to calculate or, more likely, interpret these ratios.
What's the core idea?
The golden rule here is this. Returns mean nothing without the context of risk. If Fund A made 15% and Fund B made 12%, you can't say Fund A is better until you know how much risk they each took to get there. These ratios help us make that comparison.
Let's start with the most famous one, the Sharpe ratio.
Section 16.4.1. The formula is one you must know. It's a fraction. The numerator is portfolio return risk-free rate.
The excess return.
Right. And the denominator is the portfolio's standard deviation.
So it's excess return divided by total risk.
Exactly. It tells you how much extra return am I getting for every unit of total volatility I have to endure. A higher Sharpe is better.
And when is it most appropriate to use the Sharpe ratio?
You use Sharpe when the portfolio is not well diversified. Because it uses standard deviation in the denominator, it penalizes the manager for all volatility, including the unsystematic stuff that they should have diversified away. It's also the best tool for comparing completely different asset classes, like comparing a gold fund to an equity fund.
Okay, so that's Sharpe. Now compare that to the Treynor ratio.
The Treynor ratio from section 16.4.2 looks very similar on the surface, but there's a crucial change in the denominator.
Okay.
The numerator is the same, portfolio return risk-free rate. But the denominator is beta.
Not standard deviation.
Right. It divides by beta, not standard deviation. This means it only cares about systematic risk. It ignores the unique, diversifiable risk of the portfolio.
So when is Treynor the preferred measure?
Treynor is best used for well-diversified portfolios. The logic is, if a portfolio is fully diversified, its unsystematic risk is essentially zero. So the only risk that matters is its market risk, or beta. Treynor measures the reward you got per unit of market risk you took on.
Let me see if I get this. Flag this for the exam, I'm guessing. If two funds are ranked differently by Sharpe and Treynor, what does that tell us?
That's a classic exam question. The difference is the level of diversification, or the amount of unsystematic risk. A poorly diversified fund with a lot of company-specific risk will look bad on the Sharpe ratio because its total risk is high. But it might look okay on the Treynor ratio if its overall market exposure, its beta, wasn't that high. The gap between the two rankings tells you about the quality of the manager's diversification.
That is a crucial insight. What about the Sortino ratio? You mentioned downside risk earlier.
Yes, Sortino fixes the upside volatility complaint you had. The formula is portfolio return risk-free rate divided by the semi-standard deviation.
So it only divides by the downside volatility.
Exactly. It doesn't penalize a manager for having big positive returns. It's a fairer measure for strategies with volatile upside, but it's a bit harder to calculate because getting reliable semi-variance data is less common.
Then we have the information ratio. This one seems different.
It is. It's for the active managers. The formula is portfolio return benchmark return divided by tracking error.
Whoa, the risk-free rate is gone.
It's gone. We aren't comparing to a safe asset anymore. We are comparing to the benchmark. The numerator is the active return, what people often call alpha. The denominator is the active risk, which is the tracking error.
So what question does it answer?
It answers, was the risk you took by deviating from the index actually worth it? A high and consistent information ratio means the manager is skillfully generating excess returns, not just getting lucky.
Finally, in this group, the M2 measure, or the Modigliani measure, this one confuses me, it involves leveraging or deleveraging the portfolio.
It sounds complex, but think of M2 as a way to make an apples-to-apples comparison of returns.
How?
If portfolio A has high risk and portfolio B has low risk, it's hard to compare their returns directly. M2 asks, if we mathematically adjusted portfolio A so it had the exact same risk as the market, what would its return be?
I see. It puts them on a level playing field, risk-wise.
Exactly. It scales the portfolio's volatility up or down to match the market's volatility, and then it compares the adjusted return. If that M2 return is higher than the market's return, the manager generated value. It basically translates the Sharpe ratio into a percentage return number that is much easier to understand.
We're entering the home stretch. Section 16.5 discusses benchmarking. Why is choosing the right benchmark so complicated? Shouldn't it be obvious?
You'd think so, but a benchmark defines success. If you pick an easy benchmark, you can look like a genius without actually being one.
Like a small-cap fund manager comparing themselves to a bond index.
A blatant example, but yes. The GIPS, or Global Investment Performance Standards, define what a good benchmark is with specific criteria.
What are they?
Well, I'll list the big ones you need to know for the exam. 1, its constituents are defined. You need to know what's in it. 2, it's investable. You must be able to actually buy the benchmark yourself. 3, it's consistent with the investment style. Don't benchmark a small-cap fund against the Nifty 50. It's a fundamental mismatch. 4, its historical return profiles available. You need data. And 5, it's measurable on a frequent basis.
The text also mentions manager universes or peer groups. What's that about?
That's comparing a fund not to an index, but to its direct competitors. You hear phrases like, this fund is a top quartile performer. It helps you see if the manager is good relative to other active managers, not just a passive index. But it has its own risks.
Such as?
Survivorship bias, which we will touch on at the very end.
Okay. Finally, section 16.6. Performance attribution analysis. This is the detective work, right? We know the return, but where exactly did it come from?
That's a perfect way to put it. Attribution breaks the excess return down into its core sources. Was it luck or was it skill? It usually looks at three main pillars.
Sure.
First, asset or sector allocation. Did the manager make the right big picture call? Did they overweight the right sectors, like buying pharma before a pandemic?
Okay, the macro call.
Second, security selection. Within that sector, did the manager pick the best stocks? For example, in the pharma sector, did they buy the best performing company or the worst one?
A micro call.
And third, market timing. This is the toughest one, but it tries to measure if the manager successfully anticipated broad market movements, shifting between aggressive and defensive postures.
The text also mentions a concept called net selectivity. What's that?
That is Eugene Fama's measure. It's a more advanced technique that tries to calculate pure stock-picking skill while stripping out any return that was achieved just by taking on extra diversifiable risk.
And we can't finish without talking about the currency component. The text gives a very specific and slightly scary example about the rupee and the dollar.
This is absolutely vital for anyone investing in international funds. The scenario is this. An Indian investor sends 50 lakhs to a U.S. fund. At the time, the USD-INR rate is 70.
Okay.
A year later, the U.S. fund does great. It gains 15% in U.S. dollar terms. But during that same year, the rupee appreciates against the dollar, and the exchange rate moves from 70 down to 65.
Ah, so my dollars are now worth fewer rupees each.
A lot fewer. The source example shows that even though the fund manager delivered a 15% gain in dollars, when the investor converts that money back to rupees, their actual return drops to just about 6.79%.
Wow, more than half the return was eaten by currency movement.
The lesson is clear. Currency risk is real and can completely wipe out the gains from foreign equities if it moves against you.
We have covered a massive amount of ground, from HPR to Sharpe ratios to currency drag. Expert, before we close, can you summarize the absolute must-knows for the exam day, the flashcard version?
Okay, here is your cheat sheet. 1. TWRR versus MWRR. Know that TWRR is for managers, it's the SEBI mandate, and MWRR is for clients, it's the same as IRR.
Got it.
2. Geometric mean. Use it for historical performance over multiple periods. Arithmetic mean is for a single period forecast.
Right.
3. Net return. Know that you have to deduct fees in proper order. 4. Sharpe versus Treynor. Sharpe uses standard deviation for total risk. Treynor uses beta for systematic risk.
Yeah.
Know when to use each.
And finally,
alpha. It's the excess return over what the CAPM model says you should have earned. It's the ultimate measure of skill.
And you promised a final thought, something for us to chew on.
Right. We talked about manager universes and peer group rankings.
Yes.
Think about this. Survivorship bias. When we rank funds against their existing peers, we are conveniently ignoring all the funds that performed so badly that they failed and were closed down.
They're not in the data set anymore.
They've been erased from history. So are we systematically overestimating the average performance of fund managers because all the losers have vanished? It suggests that beating the average is actually much harder than it looks.
That is a very humbling thought. It changes how you look at those top quartile rankings.
It should.
Well, to everyone listening, you know the math now. Hopefully you don't just know the formulas, but you understand the why behind the numbers. Don't let the calculator scare you.
Good luck with Chapter 16. You've got this.
See you in the next deep dive.